Hello, everyone. Welcome to the weekly roundup. Today we will cover inflation, tariffs, and market sentiments. Hello, Ben.
Hi, Eva. Happy Thursday.
Yeah, the weather today, it's like bring your packer and bring your sunscreen.
It,
It's insane.
it really is.
Okay, let's get right into it. We'll start off with inflation numbers in Canada. They
hmm
came in softer with the BOC's core measures at their lowest pace in over a year. So three questions. What's
hmm
driving this trend? Is it sustainable? And how could it shape their next rate decisions next month?
Yeah, so I think we've been trying to get a handle on directly what's going to happen. And, our economist team continues to think rates come down. And so we have the view that rates come down another 75 basis points but before the end of this year. We're not certain that they're going to cut in the next meeting in July, but we certainly think that they're coming down. This probably helps them. I think going into the print, there was something in the neighborhood of 27% probability of a cut. I'm going to guess at the updated numbers that we get on Monday, that's going to be much more like a coin toss. And so it'll continue to push in the direction of where we think things go from here. Um, I think the question around is it sustainable? I think the likelihood is it is because the economy continues to slow. And as Canada's tried to pivot away from the US with the trade and tariff war going on, the ability to do that on a dime is not really there. So the likelihood is the economy continues to slow. We've seen private payroll unemployment rising, which is another signal that we probably have a slowing economy. And if oil stays in this band, which I expect it likely to be the case, then we think that it certainly points towards lower core inflation.
Okay, speaking on tariffs, it appears that the US and China have reached some sort of framework to ease trade tensions. What are the key highlights and is this meaningful?
Well, I mean, I think on a high level, outside looking in, it's meaningful. Is it meaningful from a perspective that it's going to help Americans and help American companies? I'd say probably not. Ultimately, Americans are going to pay more for things. On the surface, it looks like it's a big win for the U.S. I don't see any way that it is. I think that it's a paper win potentially because it looks like, okay, China's come to the table, negotiated. Instead of this, we're going to get this. But I think it results in, higher costs for the consumer in the US at least. I listened to PIMCO. PIMCO is one of the largest bond manager. They do their quarterly or semi-annual outlook, I guess. And they provided kind of their guidance around what's going on. And, their guidance was that tariffs are inflationary for the United States, but deflationary for the rest of the world. And so I thought that was an interesting view perspective to think about. And I think that's probably right. Yeah.
And my next question is, the market seems so unfazed by these economic realities. Is this resilience justified, or are we heading for a correction?
Yeah, so there's lots of things to think about from that point of view. And so I think that's what I look at. Listen, all the economic data is bad and getting worse. Why does the market care? And so I think some of it has to do with liquidity, some of it has to do with the view that rates come down. And so I guess there's a bit of confidence that way. The other thing that they mentioned in PIMCO's report is they thought the U.S. consumer is in good shape. So if the U.S. consumer is in good shape, well, this economy should be okay. I'm not sure that I'm completely lined up with that, but I think some of that's the case. And sentiment is really sitting in the middle here right now. So typically when you're in that band where your things are okay, things are in the middle, you don't get a material correction into that backdrop. Usually you get super bullishness results in a correction because everyone's positioned on one side of the boat. And so I don't think that's the case yet. Bond yields too haven't broken anybody yet, but at at a 5% 10-year in the US, that's when you start to get worried. And so if we get markets continuing to tick up, if we get the 10-year continuing to tick up towards 5, that would probably be more conditions to the fact that we see a material correction. So I'd say I'm not worried today, but certainly it's a risk that we're conscious of. Rallies have been big in materials, so I think taking some profits and trimming in areas, which we've been doing, as you know, is still kind of a good strategic play at this point.
Okay. Let's go into the charts.
Okay. How's that? We can see it okay?
Yes, all good.
Okay. Okay, perfect. Yeah. So we're recording on Thursday, June 12th, around 1 o'clock right now. So anything, of course, that happens between now and the end of the week, we will comment on next week. So that's that. So this is obviously one of the questions you asked Eva is just about rates and what's going on and what we've seen. And so, certainly as we get to where we started January of last year at a 5% overnight rate, and now we've seen that come down to 2.75. So that's a big drop. And so, I think the Bank of Canada has been in front of a lot of the slowdown that we've been seeing. I think they probably didn't anticipate that Trump would come in and we'd have tariffs and so on and so forth when they started cutting rates in June of last year. But certainly they saw the economy was slowing and there was something that they needed to think about and be prepared for. Obviously, Canadian housing is a big part of our economy and markets. So housing is very reliant on rates. And so now we're down to the 2.75. And let's see what happens from this point forward. So as I mentioned off the top there, here's a prediction on rates. Yeah, we still think we see cuts coming. Obviously, I'd like to see the updated numbers on this, which we'll get on Monday morning. The Federal Reserve has no chance of a rate cut next week. Obviously, there'd be something material that would have to happen in order for them to cut next week. Chair Powell, though, continues to be under pressure from President Trump, and it looks like Bissent is likely to be the next Fed chair. If he's able to do it prior to year end, I think he will. But right now, it looks like Jerome Powell is going to continue to be on hold and stay in that positioning perspective. And then if we look at Europe here, the 100% chance of a cut next month. So they continue to be of the mindset where we need to stimulate the economy. So they've been cutting rates. You've seen stimulus in a number of countries around Europe as well, with Germany leading the way with some stimulus. So that continent is moving forward on trying to figure out how to grow from here and being conscious of all the slowdowns that we're seeing in the world. One of the other questions that get quite a bit is where are rates going? And so this was a little bit to your point on the 2-year and the 5-year and the 10-year in Canada. We think rates continue to go down until early next year. That includes overnight rates all the way across the curve in Canada. We think rates come down until early next year. So I think having exposure to bonds makes a lot of sense from that perspective. If you are looking to lock in, GICs or something on those lines, again, probably doing it sooner than later makes sense. But we still think rates continue to migrate lower. And so on a balanced portfolio, certainly that's going to help you as rates come down. The bond component to your portfolio is going to go up in that backdrop. And so when we think about year-to-date returns as well, this is a great chart of the top one would be Europe, Asia, and the Far East, emerging markets, Canadian equities, global, balanced Canadian bonds, and U.S. equities. And so, we've seen after Liberation Day, we saw material correction and we saw most markets bounce up, didn't go down as low and bounce up faster than the U.S. So, heading into the end of May, U.S. was one of the worst performing markets year to date. And so that's an interesting view given the backdrop and setup for what President Trump is looking to accomplish. But his answer is probably short-term pain for long-term gain. So we'll see how that plays out. but US underperformance for the first time in a very long time. And just around the trade tariffs that we're looking at, this chart goes back to 1825. Gone through a lot of periods right now, but we're up here in the neighborhood of tariffs where something we haven't seen, certainly in my lifetime and a lot of investors' lifetime, is where tariffs are at significantly elevated levels. And so, if we're going to stay up here, then we need to be conscious of what that means. And to the point of what PIMCO said, where you know, we may get some resulting inflation uptick in the US, but the rest of the world is getting a deflationary impulse. That's interesting. And that's interesting from a point of view of, well, rates come down, that stimulates other countries, and maybe the US dominance in equity markets won't necessarily continue to be the case for the next couple of years. Another way to look at it is just emerging markets versus the S&P. So, since I guess we probably peaked around 2009, where EM was outperforming. Now we've gone a very long period of time, 16 years or so, where we've had the opposite of that. So the question is, do we get a reversion to the mean at this point? I think the answer is we probably get a narrowing of that gap, and having some international exposure, particularly emerging markets exposure, makes a lot of sense at these levels. And so, Eva, you asked a little bit about rates and inflation going to continue to come down and such. So, as I mentioned, private employment, we're starting to see unemployment tick up in May. And so these would be additional signals that give the Bank of Canada some room and some more confidence and comfort to cut rates in this environment and see to how do we put businesses in better shape? How do we put them in a point where they want to hire? But that isn't the case right now. And so I know we talk about this each week, and Eva, you'll mention it when we do the wrap up here, but we post the daily here, and Eva's been sending out the dailies now in the email. But anything you're looking for, any past newsletters or research that we've put out in the past couple of months, you can refer back to this page and take a look at any of the past comments. Certainly around what's going on in volatile markets, maybe a good time to look back and see where we're at. And of course, if you miss any of the videos, you can visit on the YouTube channel that we have located here as well. As always, the opinions expressed do not necessarily reflect those of National Bank Financial. Should you have any questions or want to understand if this is a suitable investment for you, please contact myself or your advisor, and we're happy to provide more guidance for you from that perspective.
Great. Thank you, Ben.
You're welcome.
You had a lot of charts today.
Yeah, I went over my limit today for sure.
It's okay. You're forgiven.
Thank you.
So, what should we look out for next week?
Yeah, so probably the most important thing next week certainly will be the central bank meeting in the US. So yeah, the FOMC on Wednesday next week. So we'll be watching that. They don't look like they're going to cut rates, but it'll be important to watch and see what Powell says. If you've been following Trump, he's been on Powell to say cut rates, cut rates. We need rates lower, and he's making a wrong choice. So it'll be interesting to see what happens there. Obviously, if Trump is able to find a way to remove Chair Powell from the seat, I think he will. But we'd be watching the notes and the presser and those kinds of things next week to see what direction he's getting. The other area that I continue to watch and monitor, of course, is gold. It's one of these things that started to move from deep in the back pages of the papers now up to the front page. And so that's how you make money, is buying something on the back page and then wait till it gets to the front page. And so now we start to look at and go, how sustainable is this trend? Do you take profits on it? Is this something that we need to continue to stay with? And so that would be something that I'd be watching quite closely, as well, as we're around 3,500 gold in US dollars right now. So I'd say those would be two of the key things that I'd be watching. And the last one always people ask is, what's that one thing that I should watch? And I do think it's yields. So, look at the direction of yields either in Canada or the US, depending what you think is relevant. Certainly the US drives market returns. So, as you watch that 10-year US Obviously, if the yield goes up, that's a little bit worrisome. If the yield goes down, also worrisome. But something to think about. One thing I'd be watching is that US 10-year to give you a signal and direction for where we go from here.
Great. Thank you, Ben. Ben already did the wrap up for us, but head over to YouTube and LinkedIn at Hart Investment Group for all the videos and our daily heartbeats. For our clients, please reach out to me if you have any questions or if you'd like to book a portfolio review meeting with Ben. Thank you, everyone, for listening and have a good rest of your day. Bye.
Thanks. Take care. Bye.